Good day, my name is Dean Crocker and I'll be taking you through the latest EIA report completed on Remgro. On the 25th of March 2021, Remgro released their first half 2021 results. The results were influenced by a significant decline in Mediclinic's contribution, which was roughly 80.2% lower, and this was materially impacted by COVID-19 related lockdown measures. The group was further impacted by a significant reclassification in terms of accounting of First Rand from equity account investments to investment at fair value. The resultant impact was a significant decline in HEPS, down 52.8%. Pleasingly, however, the intrinsic net asset value grew by 4.9% to 161.9 Rand per share. Noticeably, First Rand was up, Distill was higher, Rand Merchant was higher, and net debt declined by a nice 8% to 1.6 billion. Material investments made during the period and subsequent to year-end, they increased their stake in RCL by 77 to 80 million, to 80%, whilst KTH increased its stake to 43%. CIVH was also increased to 55.2%. Post-year-end, and on the 18th of May 2021 to be precise, Heineken NV made an offer to acquire Distill from most of the shareholders in Distill. This includes Remgro, which holds quite a sizable portion of Distill. The results also led to a total dividend per share being declared of 30 cents per share, which was significantly lower at 86% decline. This was largely due to COVID-related impact on the various underlying investments, particularly with Mediclinic and First Rand not declaring any dividends really. So, on date of release, the share price declined by 1.73%, whilst the JC All Share closed 0.68%. This resulted in a negative impact or negative result from investors. Since the beginning of the year, Remgro has, however, outperformed the benchmark by 9.2%, with a year-to-date return of 26.3%. On a reported price-to-book basis, the group now trades at a 24.6% discount to its 5-year average and a 55% discount to its FactSet peers. This is not uncommon, as most holding companies at the moment are trading at significantly larger discounts to their intrinsic value and particularly their historical averages. The price to intrinsic value of 35% relative to its 10-year historical discount of 17% is quite sizable, and the group therefore does seem to offer significant value or upside, given that the company is trading at such a large discount. So the assessment. Remgro is trading at a significantly wider than average discount. It has been increasing year on year, and we've seen this across all holding companies that there is a bit of a challenge for management to close the discount at the moment. We are, however, also quite keen to find out what the proposed transaction may be with Heineken in terms of the potential acquisition of Distill. Following the announcement, Distill had run quite significantly, if I remember correctly, it was up more than 80% year to date on the back of that news, and this may have material impact for Remgro. However, we do not see Remgro selling it for cheap, particularly given they require highly cash generative investments that pay out dividends, and this is required to ensure that Remgro has sufficient liquidity within the business to meet both their capital commitments as well as repay holding company debt. One concern that we do have is the continued support for CIVH. They have continuously allocated quite a large portion of capital towards them, which we feel could have been probably better allocated, and CIVH has continued to show poor results. What is favorable for Remgro is they continue to hold very vast and diverse underlying investments, both in terms of sector and in terms of geographic location. So they do have very high quality assets, and most of them are very liquid in nature with strong cash flows. This allows Remgro the ability to service its internal holdco debt. As mentioned, and as you can see as my one point, that remains our largest concern, and really it is a large concern for all holding companies, is when holdcos start to incur debt to support underlying investments or subsidiaries, they do need to have some sort of means to extract value back out of those underlying investments back into the holding company to repay the debt. Now, albeit that Remgro has quite a sizable amount of liquidity within the holding company and they do not seem to be at risk right now, it is just a concern that if the liquidity were to start to dry up, that they may have to start to sell or liquidate underlying investments. Now, that is not in any way a great scenario. Thus, that remains our biggest concern whenever we look at Remgro, is to ensure that the liquidity within the business is sound to meet their debt requirements. Given all of that we have discussed, the group is trading at a significantly wider or larger discount to its intrinsic net asset value, and much larger and wider than that of historical peers and its historical average. For that very reason, and given that it is a sound balance sheet with sound underlying investments, we have maintained our overweight recommendation. We do, however, note that in order to decrease or have a revision towards the longer term averages in terms of the price to intrinsic value, they remain dependent on the medium term recovery and profitability of the underlying investments. You've seen that First Rand did not have the greatest set of results, and we've also seen Mediclinic come in at significant pressure. As soon as those investments, which are some of the larger investments, start to turn around, we should hopefully see a minimize or a decrease in the price to NAV. If you'd like to place a trade, speak to your financial advisor. Alternatively, the trading desk would be more than happy to assist. Please take note of the disclaimer and have a great day further. Thank you.